Welcome to the QI Corner, where we will discuss all things 1031 exchanges from the qualified intermediary's perspective, sharing the things he sees when engaged with a 1031 exchange. I am 1031 Broker James with Best 1031 Online, and with me, my co-host, Greg Burns, the godfather of the 1031 with IPX 1031. Greg?
Hi, James. How are you?
I am fabulous. How are you?
Godfather just makes me feel old. So I have been in the business for 25 years. As you know, I work for a qualified intermediary called IPX. We're a national qualified intermediary, so people call us an accommodator, facilitator. We've been in this for almost 30 years. So I'm happy to be on the channel and answer any 1031 questions you can lob my way.
Absolutely. So you and I met when I was with Marcus Millichap. Everybody knows you pretty much hit up all the brokerages to share with them your knowledge about the rules and performing exchanges and whatnot. Done a few deals together. And again, I really appreciate you participating. We're going to have fun with this. I can already tell. So this month, we're going to dive into a case that I brought to Greg a couple weeks ago, Seller Carrybacks. And doing Seller Carrybacks as an exchange. So the case is that I have a client who I'm currently selling a property for, and his girlfriend is an attorney, that the two of them had owned a single family home rental together. He owned 55%, she owned 45%. And the way the deal was structured is that he took his 55% at the close of escrow. She did a seller carryback on her 45%, collected interest on that, but didn't collect the principal. And that note's coming due. And she called me and said, hey, while we're talking about selling our other property, I wanted to tell you about this and let you know that I've got $2 million that I'm going to collect in December, and I want to do an exchange. I was not sure. So I called Greg. And Greg, what did you tell me?
So I wish that I could figure out a way to make that happen where you could sell your property today, carry back a note, and then 3 to 5 years down the road, then decide to do an exchange. Right. I think notes are becoming, fairly common in real estate transactions. They've kind of been that way since rates shot up. And so people typically can get a little more money a lot of times for a property if they're willing to carry back financing on it. The challenge is when you're doing an exchange is that you need the cash from the sale to be able to complete your exchange. And any portion that you carry back in a note is taxable as the principal payments are made. So, one of the things that you have to kind of, think about if you're selling your property and you're carrying back a note is, hey, if I'm carrying back a note, am I willing to pay taxes on this note once the principal payments are paid off? And if you're not, there are kind of a couple ways to deal with it. One, obviously, you can just tell the person, I'm not willing to carry back financing and, go get a conventional loan. The other thing, though, is I had a client last week that was closing on a deal. It was a pretty decent-sized deal, but the buyer was asking him to carry back a $250,000 note. And so the client said, I really don't want to pay taxes on this money. And he had money sitting in a bank account that he could use to fund the bank and to fund the deal. And so he acted like the bank. And so when the sale closes, the buyer is going to come in with their funds, and then the seller is going to come in with $250,000 of their own money. And they're going to act like a bank, send that money to escrow. And when the sale closes, all of the proceeds will be sent over to QI. So now the QI will have all the cash for the exchange, and they can just, enter into a regular 1031. So, you have to basically find a way to convert that note to cash during the exchange period.
Well said. And there you go. I think what happens is come across my desk before, as I'm sure it has come across yours as well. And because people have the thought, which is partially correct, that, hey, as long as I don't take my proceeds, because I'm not supposed to take my proceeds. So they think that, hey, if I do a seller carryback, then I'm not taking the proceeds.
Right.
But to your point, when we talked, is you said, look, she's already agreed to the actual price, so there's value accepted. And that's, I think, what was key in that point.
Yeah, she kind of realized the gain. She just hadn't recognized it yet because she hadn't received the proceeds. So she's probably been reporting it on her tax return under Section 453 as an installment sale. And then, once obviously the note gets paid off, that's when she'll realize the gain and go ahead and have to pay taxes on it.
Right. Interestingly enough, there are some ways, seller carryback can be a great way to defer the capital gains tax. You're not going to be able to, you're going to pay them. You're not going to be able to defer them like you would with an exchange. You're just going to pay them on a much slower pace, straight.
Yeah, we have clients that carry back notes where they're like, listen, I don't want to own real estate anymore. I'm happy with the price I'm getting for the property. So I'm going to carry back maybe an interest in principal note for the next 10 years. And so they get a little bit of interest, a little bit of principal every year, and then they pay kind of their taxes as they go. So, and then we have clients that carry back interest-only notes, which are just saying, listen, I'm okay with paying the taxes on this money. Some people exchange the down payment. They sell a deal, let's say for $5 million, they get $3 million down. They carry back a note for $2 million. So the $2 million note's going to be taxable when it's paid off. Let's say it's a 5-year interest-only note. So they exchange the $3 million, and then at the end of 5 years, when their note gets paid off, that's when they owe the taxes. So, a lot of times, it'd be like a delay of paying the taxes, not really a deferment.
That's an interesting concept of obviously in a larger price point property where you get, 60 or more % down and exchange that amount while carrying back a balance. I like that.
Yeah, I mean, sometimes you kind of get a little bit of the best of both worlds. Maybe their gain is more significant than that. I mean, I talked to a client today. They actually earlier today when I spoke to you on the phone, they had bought this property. It was like a hotel. They bought it for like $70,000, and now they're selling it they bought it in the 80s. Now they're selling it for $5 million. So, in a situation like that, if you're selling for $5 million, you get $3 million down, you can still defer taxes, right? I mean, by doing exchange on the $3 million you get down. I mean, you are going to realize some gain when you get the $2 million note paid off, but there's still some benefit there, and you get the income from the note. Some people look at it like, hey, I can get income from the note over the course of the 5 years that I have it, and that'll help offset the taxes that I owe when I have to pay those in year 5.
Excellent strategy. That's the thing that I profess on not only the channel here, but with my clients is that an exchange is so powerful and so flexible that it really depends on what your ultimate financial goals are. And to that point, neither Greg or I give legal or tax advice. We're just here to help make the transaction as smooth as possible and as successful as possible. My tagline is the best 1031 is a successful 1031.
That's right. It's like the best pitch in baseball, strike one, right?
I know it's crazy, but we are in LA, and I'm going to go ahead and say go Dodgers.
Yeah.
Game 3 is tonight, so hopefully we have a historic World Series win. So, Greg, thank you very much for your time today. I'll go ahead and wrap up this month's episode of the QI Corner. See you in November, and we'll have something fun to talk about then.
All right. Well, hopefully we'll be celebrating the Dodgers still.
Right.
All right. Take care.
You too. Bye-bye.